Right now, Nebius Group NV, trading under the ticker NBIS, is at $105.16, and it is having a brutal intraday session, down $4.79, or 4.36%. This is a stock in motion with heavy volume, and what we're seeing is a violent reaction to the company's third quarter 2025 earnings, which just hit the wire. Many investors looking at this ticker for the first time might be seeing the massive 500% run-up it's had in the last year and are just now noticing this sharp, painful pullback. The immediate expectation is that this is a bubble bursting, that a high-flying tech stock is finally coming back to earth. But the reality of what Nebius Group actually is, where it came from, and what was in that earnings report is far more complex and, frankly, far more interesting than just another volatile tech chart. This isn't a simple story of a stock going up and coming down. This is the story of a corporate rebirth, geopolitical fallout, and a massive bet on the future of artificial intelligence. The common belief about this company, if people have one at all, is fractured. Some hear the name and draw a blank. Others, who've done a little digging, might know the name Yandex and immediately associate this with the Russian internet giant. That's the expectation, that this is somehow still Russia's Google, a search engine and ride-hailing app based in Moscow. But that reality is completely, fundamentally wrong. The company you're looking at, Nebius Group NV, is the ghost of the old Yandex. It's what was left after the Dutch parent company, Yandex NV, was forced by the geopolitical earthquake of 2022 to sell all of its Russian assets. That deal, a multi-billion-dollar divestment, finalized in July 2024. The original entity, stripped of its Russian core, renamed itself Nebius Group, held on to its international assets, and in October 2024, it resumed trading on the NASDAQ under this new ticker, NBIS. So when you buy a share of NBIS on your Fidelity or Robinhood app, you are not buying a piece of the Kremlin-linked search engine. You are buying what is essentially a brand new, Western-focused, Amsterdam-headquartered AI infrastructure startup run by Yandex's original, estranged founder, Arkady Volas. It's one of the most dramatic corporate transformations we've seen in decades, and the market is still figuring out what it's worth. So, let's talk about today's 4.4% drop. It's all about the earnings report. The expectation, given the stock's meteoric rise, was for perfection. The reality was messy, which is typical for a high-growth company. Nebius reported a staggering 355% year-over-year revenue increase, hitting $146.1 million for the quarter. This is explosive growth. It confirms the AI narrative. They are building out data centers, they are selling GPU capacity, and the demand is white-hot. They even highlighted a massive new $3 billion agreement with Meta to provide AI infrastructure. This is the kind of news that should send a stock soaring, but it didn't. Why? Because the other side of that reality is the cost. The company posted a net loss from continuing operations of $119.6 million. This is a massive cash burn, and to fund this rapid expansion, the company also announced an at-the-market equity program. In simple terms, they are going to be selling new shares into the open market to raise cash. This is dilution. It means every existing share is worth a slightly smaller piece of the pie. This is the classic tension for a growth stock. You have to spend huge amounts to grow, but that spending spooks investors who are worried about profitability and dilution. This is the same story we've seen play out in Tesla stock for years, and it's what separates long-term believers from short-term traders. This 4.4% intraday swing isn't happening in a vacuum. The volume is enormous. We're seeing institutional players, the big funds managing their Schwab Intelligent portfolios or clients at Fidelity Wealth Management, making huge decisions. The news of the Meta deal and the Nvidia backing has brought in a lot of fast-moving capital, but the earnings loss and dilution announcement is giving the bears plenty of ammunition. This stock is now a battlefield. Just a few weeks ago, Nebius was riding high on news of a $19.4 billion deal with Microsoft to provide dedicated GPU capacity for Azure. That news sent the stock up 200%, so the expectation was that this company could do no wrong. Today's reality check is that this expansion is incredibly expensive. This isn't like buying Apple stock, a mature company that prints cash. This is a speculative venture. It's a bet on spending billions on data centers in Finland and New Jersey will pay off in a world that is desperate for AI compute power. It's an online investment that requires a strong stomach. Many retail investors, perhaps using the Robinhood app or SoFi Invest, are likely seeing this drop and facing their first major test of conviction. What does Nebius actually do? Forget the old Yandex search engine. Nebius Group is a full-stack AI infrastructure provider. They are building the picks and shovels for the AI gold rush. They have a few core parts. Nebius AI Cloud provides large-scale GPU clusters, the supercomputers that are necessary to train models like ChatGPT. This is why they have deals with Microsoft and Meta, and why they are backed by Nvidia. They are a direct competitor to other infrastructure players like CoreWeave. Then they have Toloka AI, which is a data labeling platform, a crucial service that helps refine AI models. And they have Avride, which is the self-driving technology unit. This is a pure play on the AI hardware and services boom. The business model is to build massive capacity and rent it out at a premium to the tech giants who are all in an arms race to build the next great AI. It's a fantastic business to be in, if you can fund it. The risk is that they're competing with giants. Amazon, Google, and Microsoft are all building their own infrastructure. The expectation is that Nebius, with its smaller, more focused approach, can be more nimble. The reality is that they are a minnow swimming with sharks, and they are burning cash to stay in the race. Let's look at the recent past. This stock, NBIS, only re-emerged in October 2024. It's been on an absolute tear from its lows to a high of $141.10. That's more than 500% in a year. Investors who got in early, who understood this transformation story, have made a fortune. This is the kind of online investing success story that people dream of. But now, at $105, it's 25% off its all-time high. This is a serious correction. The momentum has clearly broken. The question for anyone looking to invest online or use investing sites to find the next big thing is this a healthy pullback and a buying opportunity, or is the party over? The reports from Q2 2025 were all optimism, with revenue soaring 625% and the company claiming it had reached adjusted EBITDA profitability. That set an impossibly high bar. Today's Q3 report, with its massive net loss, feels like a cold shower. This is where investors need to be careful. Platforms like Interactive Brokers, which are geared towards more professional traders, are likely seeing massive order flow in both directions. This isn't a stock you just buy and hold in a Fidelity brokerage account without paying attention. This is an active, volatile, news-driven name. So, what is the future outlook? This is where the expectation versus reality framework becomes critical. The expectation, pushed by the bulls, is that Nebius is the next Nvidia, or the next great cloud provider. They'll point to the Microsoft and Meta deals as proof that its technology is essential. They'll argue that the company's $1 billion investment plan for new data centers is exactly what it should be doing. They'll say that in a few years, today's $119 million loss will look like a rounding error when the company is generating billions in high-margin revenue. They'll look at the leadership, with Yandex's original founder at the helm, and see a visionary, battle-tested team that has already survived geopolitical disaster. They see a company, now free of its Russian ties, ready to conquer the Western AI market. It's a compelling story. It's the kind of story that has driven Tesla stock to unbelievable heights. But then there is the reality of the risks. The bears have a very different take. Their reality is that this is a company burning through cash at an alarming rate. That new at-the-market equity offering is a red flag, signaling they need more capital and they need it now. The bears will argue that competing with Amazon AWS, Google Cloud, and Microsoft Azure is a fool's errand. Those giants have endless cash. Nebius does not. The bears will also point to its legacy. While it is legally and operationally separate from Russia, the shadow of Yandex is long. Will some institutional investors managing their Fidelity ETFs or Fidelity mutual funds be hesitant to get involved? Will geopolitical tensions create headline risk, even if it's unfair? And what about the valuation? Even after today's drop, this company has a market cap in the tens of billions of dollars, all while posting huge losses. The expectation is for growth, but the reality is that the market is paying a massive premium for a story that is not yet proven. This is a stock that could, in theory, fall another 50% and still look expensive on traditional metrics. This is the central conflict.